Welcome back everyone to the Money Control live stream. You are watching Markets with Santo and CJ. Well, it's quite a bad day for bulls. It seems the weakness in the market has only gotten worse from the start of the day. We are currently at the lowest point of the day, tracking some negative cues that are emerging from global markets. If you look at the Nifty 50 and the Sensex, both are trading about 0.8% lower and are headed for second straight day of negative close. In the global markets, Asian markets were largely mixed, although tilted towards the negative side, while European markets have also started off on a weak footing. Now, inflation has become a dominant theme again after the rally that we have seen in crude oil prices, Santo. And although oil prices are off about 5.5% today from the highs of about $124 that they touched overnight, but it still remains a key risk for the market, given that inflation overall has been a very dominant theme, and a lot of the rate trajectory or the trajectory of how central banks approach interest rate hikes depends on how inflation fares.
Well, CJ, inflation has now been a dominant theme for a long time.
Yeah.
In fact, for more than 3 months now, ever since the war in Ukraine started. It's just that market occasionally looks at it, then as per its convenience, tends to overlook it. And right now, again, we are into a phase where market seems to have realized that crude prices are on the boil,
Yeah.
and now probably we should cut down our exposure to risk assets. But CJ, tell me, you seem to look at everything from the perspective of the bulls. The bears also make money, right? It's
Absolutely,
not just
absolutely, that is true. I mean, actually, if you talk to a lot of people in the market, the argument for the recent rally that we had seen, the pullback that we have seen about from 15,800 odd levels to almost as high as 16,700, the argument it seemed was that probably in the US, inflation has started to peak, and because there were concerns over growth becoming slower and slower going forward, the US Federal Reserve may not actually raise rates even beyond September. I mean, some people were actually arguing that probably the last rate hike might only happen in September, and there onwards US Fed might go on a lengthy pause, right? Similarly, in India also, a lot of brokerages are of the view that inflation will peak out in 2 to 3 months. Now, that was before the spike in crude oil prices, right? At that point of time, oil was hovering around 105 or 110. Right now, it's about 170 to 124. So therefore, oil again is the biggest determinant in this year, and how the narrative shifts in the market. And this is a market where narrative is shifting every day, if not every week, right? And therefore, we are seeing these sort of tug of war that we are seeing between value and bears and bulls, if you may call it that way. So for me, at this point of time, this is a market where you have to be very, very nimble, very, very agile, and very, very adept to change with the news flow, I feel.
Well, CJ, this market, I know, I mean, the best thing to do is to be agile, nimble, but it's really hard to catch the trend.
Yeah.
It's
There
very
is no
tricky.
trend, actually.
Yeah,
There is no trend.
it is quite tricky in that sense. Well, with that, we dive into the stocks on our watch list today. So I'll start off with HDFC Bank. Now, CJ, the HDFC Bank stock saw a big run up, on the day when they announced this merger with HDFC.
Yeah, well, wasn't that a bull trap of centuries?
Yes, well, that was a kind of a bull trap, and after that, you've seen the stock, come up very sharply.
Absolutely.
And it's been underperforming for a while now. So much that some people feel that many in the market feel that maybe under pressure from investors, HDFC Bank may actually go back on that merger plan. But in an analyst call yesterday, they clarified that at least no investors have openly voiced opposition to the merger, and it's very much in track, and they are expecting the RBI approval for the same. Now, Macquarie has come out with a note. It has rated the stock outperform with a price target of 2005. Macquarie's pitch here is that the number of branches that HDFC is investing in aggressively, that will lead to a huge increase in its deposit base. It's looking, Macquarie is looking at a deposit CAGR of about 25% in the deposit base. CLSA too is quite positive on the stock, and has said that because of the underperformance, valuations have become reasonable. So I think this is one of the stocks to keep an eye out for, CJ.
Well, Santo, I take your argument about deposit base growing and the company trying and the lender trying to expand this branch distribution network, but for me the merger still remains the key dominant narrative for HDFC Bank as well as HDFC, of course. Now, if you look at some of the commentary that is coming in from analysts, some analysts believe that lender is slowly and steadily losing its right to premium valuation. Now, HDFC Bank, you and I know both that it has always been valued at a premium to even the best of best, even within the private sector, right? So that right to premium valuation is slowly and steadily decaying, largely because analysts feel that the bank is now coming in line with some of the other private sector, big private sector banks, such as probably ICICI Bank, Axis Bank, and in the PSU space, maybe SBI, right? Now, why they are saying this? Their argument is that, HDFC Bank always distinguished itself on its underwriting skills. If you look through the great NPA crisis that the banking sector had from between 2015 and 2019, HDFC Bank was out and out outperformer because it never saw the sort of asset quality issues that probably banks like ICICI Bank and Axis went through. Now, Kotak Equities came out with a report suggesting that they feel that this underwriting differentiation that HDFC Bank had is now slowly fading away, and therefore it probably buttresses the argument that the bank does not need to be valued at a premium to banks like ICICI. Apart from that, if you look at the loan book also, generally HDFC's loan book had always been like a peach. It was probably the best loan book with the minimum amount of risk. But now, as the bank is expanding its footprint in the corporate loan side, there is more and more cyclicality coming into the loan book. It is very likely that in the future, HDFC's loan book will move in tandem with how the economy is moving, right? And that also is another factor that Kotak Equity believes will push investors to cut down on the premium valuation. And the entire multiple story is what it is the main driving force of the stock. Should HDFC Bank's multiples come down from the heydays of the bank over the last decade? And this merger definitely has made the case that HDFC Bank does not enjoy the same sort of multiples that it did once upon a time.
Well, I don't quite buy that argument about underwriting skills. In fact, it's underwriting skills, which are the big distinguishing factor between banks and so-called fintechs, which can just use technology. But at the end of the day, as someone had pointed out, the argument is that fintechs can never actually match banks when it comes to lending, because there's a huge difference in the quality of underwriting, and that is what has, distinguished HDFC Bank so far. It's taken good tactical bets also, where lending to smaller businesses was involved, and that is how it managed to have a very fat net asset margin. I don't think that's going to go away overnight. That's the short.
No, it's not about HDFC Bank versus fintech, Santo. It's about HDFC Bank versus ICICI Bank or an SBI or an Axis Bank. That is where actually they enjoyed the differentiation. That is where they enjoyed higher skills in terms of underwriting their loan, even the worst of loans in retail segment. But that differentiation is slowly going away, especially now that, when the mortgage book of HDFC will become part of, HDFC Bank's own loan book. That itself is going to create risk for the overall loan book or the advances book for HDFC Bank. That is the argument that Kotak is giving, and that is why they feel that probably going forward, the heydays of valuation multiples that HDFC used to enjoy. That at one point of time it was valued at 5 times, 6 times price to book. Those multiples probably may not come back anytime soon.
We could argue on this for another hour, but we'll keep it for some other day.
Well, one stock that is going to enjoy some sort of premium valuation from investors is Nandan Denims. This is a small cap stock in the textile space. The company came out with a good set of numbers for the March quarter. If you look at the Q4 sales, they jumped about 94% on a year-on-year basis, while higher cost, of course, ate into the profit growth, because the profit growth was only into high single digit for the company on a year-on-year basis. But hearteningly, the cash flow from operating activities saw a big jump in the quarter, Santo. Almost 190% year-on-year jump in operating cash flow, which goes to show that the operating side of the business is quite healthy for Nandan Denims. Apart from that, this is also a theme story. I know you are quite averse to theme stories right now in this market. But if you look at the efforts that the government is putting in trying to, bring up textile exports, last year, FY22, we saw record textile exports, from India, and Nandan Denims, being an exporter to almost 27 countries out there, is a clear beneficiary of that, push that the government is giving. Apparently, media reports suggest that government is going to come out with second installment of PLI scheme or productivity linked incentive scheme for textile sector, and that could also be another bump, trigger for the stock going ahead.
CJ, is this your again 5 or 10-year bet kind of thing?
This need not be. It is textile in itself is an established industry, right? Like compared to, say, for example, contract manufacturing for electronics like Dixon Technologies, which was not an established player. Like it has been trying to create a niche for itself. Textile used to be in its glory day one of the biggest export stories for India, even more than IT and pharma at one point of time. So this is about a revival story than a 5 to 10 year bet, and probably you will not even have to wait 5 to 10 years to see the results for Nandan Denims.
My argument against the stock, just looking at the long-term chart of the stock, which is going back to 2006 or 2005, it's never made money on a long-term basis. It's been purely that cyclical play where suddenly one fine day for maybe 6 or 8 months the stock just shoots up, and then the craze with textile is over, and then after that again you have the stock languishing for a long period. Here also, if you see, just about a month back the stock had climbed to 68 rupees and now has come down to half that price. I take that point about valuation, that it's going for less than book, that makes it in a way attractive. But look at the margins, 7% margins for FY22, and margins used to be 15% in 2006, 2017, right?
Yeah.
And even though while the top line has grown quite a bit, in fact it has more than doubled, you see the bottom line has not grown much at all. So to me this is a very, very one of those plays, as you would say, you have to play it nimbly, tactically.
It is a tactical play. That
it has to be a tactical play.
Also, see, margin of course has come under pressure because you have competition not only at home but also globally. I mean, China being a dominant textile exporter, Vietnam and Bangladesh emerging as viable competitors to Indian textile exporters. Margins globally have taken a hit for textile exporters given the rise in competition. But now, of course, with China probably dragging its feet from the export market, and probably with the government support, Indian competitors, being at a level footing with Bangladesh and Vietnam, maybe you could at least see some sort of bottom for margins in the years ahead. And maybe who knows, if the growth in Western economies remains intact that we have seen in 2021, maybe the top line growth could be the bigger narrative than profitability.
Well, just a quick look at the market. The indices have come off the day's lows. There's been a bit of a recovery.
That's a good sign. That's a very good sign, at least from the point of view of the bulls. And clearly, is the
on
Nifty
whose
bank
side CJ always perennially seems to be on.
Definitely, and it's the Nifty mid cap and Nifty bank sectorally. Nifty bank is doing quite well, and this is one sector where domestic investors have been saying time and again that reasonable valuations, good outlook on growth, and this is probably the place to be at this point of time in the market, and clearly that outperformance is showing for Nifty bank.
Well, the third stock on your portfolio?
Well,
it's Interglobe Aviation.
Yes.
That's a stock that I'm very bullish on. Now, the stock
surprisingly.
has been, well, yeah, I know all that thing about aviation stocks never making money, but now if you look at the business side of it, there's been a considerable improvement there, CJ, and that is testified to by none other than the outgoing CEO of Interglobe Aviation, Ronojoy Datta. In an interview to CNBC TV18, he said that travel has picked up in a big way. In fact, now business is almost better than what it used to be pre-pandemic. Of course, high crude oil prices are hurting, but Indigo is taking a number of steps to improve their revenue per passengers, and once crude oil prices start softening a bit, then you're going to see a big upside in the stock, CJ.
Santo, I am not really convinced by that argument. Crude oil prices are not going down anyway. I mean, I know that Ronojoy Datta, in his interview said that he wants crude oil prices to behave, but believe me, they are like the rowdiest kid right now in your classroom, and there is no way that you can control their behavior. So I don't think there is going to be any comfort on cost side, at least for the near term for Interglobe. The higher fuel costs, which account for almost 40% of his cost structure, will continue to eat into margins. And it's not only fuel that is going to eat into his profitability, Santo, it's rising competition. You have Jet Airways coming back from the dead. You have Jhunjhunwala's Akasa Air coming, slowly and steadily building up to launch its services. So two new players coming into an industry, along with an old hand like Air India, which is on its way to a turnaround under the new ownership of the Tata Group. So I feel this sector is going to heat up quite dramatically, like the heydays of probably 5 to 7 years ago, and that could possibly eat into further into the margin and profitability of the business, as well as cash as they invest heavily on trying to expand their carrier capacity, as well as on promotions.
Two short points here, CJ. In the past, Interglobe Aviation has managed to handle competition pretty well. It's been now around.
Well, Santo, in the past, Interglobe was the disruptor. This time around, it could be the one disrupted, right?
Second point, crude oil prices. It's not for the first time that they're rising. Okay, they've battled higher prices in the past too. But this is the time, ideally, when you're looking to buy any aviation stock, the ideal time is when crude oil prices are very high, because from there things only keep getting better, because already on the business side you're seeing an improvement there.
Well, I hope your confidence pays off. Well, one stock where the confidence of the market is dwindling a little bit today is Bajaj Auto. Over the past 2 to 3 months, the stock has done quite well, along with other auto sector companies. But the May sales data of the company was quite disheartening. They came in better, weaker than the estimates of analysts, and that has led to a 3% dent on the stock today. If you look at the internals of those numbers, it's the export side, Santo, that has concerningly seen the most deterioration, while domestic sales have risen on a year-on-year basis, considerably so. It's the export which was the driving force for Bajaj Auto for so long during the pandemic. That has seen a almost year-on-year decline of 15% on the two-wheeler side and 60% on the three-wheeler side. So clearly, the supply chain issues in the global economy, the Ukraine-Russia war is having an impact there. Plus, the bigger concern here is that production itself is getting hit by semiconductor crisis. The management told CNBC today that they are facing quite an acute shortage of semiconductors since March, and this is something that has been corroborated by Maruti Suzuki as well in his comment later in the day. So for me, clearly the revival story in the auto space, especially in a two-wheeler stock like Bajaj Auto, is not working out at this point of time. There is just not enough evidence to convince investors that this is one sector that is finally going to get out of the woods and probably be on a turnaround journey for the next 3 to 4 years.
Well, CJ, I would go by the price chart at this point in time. If you look at the price chart, it seems to be indicating that the market may have already discounted it. It had been falling for a while. But
if it had discounted, Santo, it would not fall 4%. I mean, it seems like market was taken by surprise by the poor numbers for May.
See the overall how the market has fared over the last month, and see how Bajaj Auto stock has fared. It has not fallen as much as the Nifty has. So probably the whole thing about two-wheeler segment going through a lot of stress. Also, the fact that fuel prices are rising, interest rates are set to rise, rural sales, rural incomes for that matter have remained low. All these seem to be now have been discounted in the stock price. So probably, yes, I don't see the stock running away anytime soon. But
I doubt it can even walk, Santo, at this point of time. Running away
no,
is
but I don't see much of a downside to this stock either from these levels.
I can't convince you, but I feel that this is one stock that probably at this point in time you better not touch. You rather wait for the sector leader, Hero MotoCorp, which actually can benefit from the revival, the expected revival in rural income and rural demand going ahead, given that Bajaj Auto is largely not that present in the rural space compared to Hero MotoCorp.
Well, the last stock on our watch list today is Apollo Hospital. Again, a steep sell-off in the stock over the last 1 month. Probably that's one of the reasons many in the market now feel that valuations are beginning to finally look attractive. Now, the fourth quarter numbers were pretty, it were in line with what market was expecting, but obviously there's a lot of investments right now going into its 24/7. This omni-channel which had been trying to sell a stake in, and also occupancy levels were a bit low during the fourth quarter,
yes,
but now those are slowly beginning to pick up. So these are the two main triggers for the stock: improvement in occupancy levels, which most analysts say will now start picking up as more people are opting for elective surgeries, and also the fact that it's an integrated player in the healthcare segment.
Santo, the delay in the minority stake sale in Apollo 24/7 was a little disappointing from investors' point of view, because a large part of the runway, run up in the stock was in anticipation of that introduction of a strategic investors, which could have unlocked value in the 24/7 business, which also, let's believe, is probably the faster growing side of the business for Apollo Hospital. Apart from that, concerningly, the occupancy rate declined not only for the older hospitals, Santo, but as well as the new capacity that the company has brought in over the past 3 to 4 years. That goes to show that still occupancy levels are not at the same level as they were prior to the pandemic for a lot of the hospital companies. Interestingly, the revenue per patient was quite steady, largely because some of the higher end surgeries had come back as COVID declined. But the low occupancy level, I don't think that there is enough evidence to suggest that that will improve in the coming quarters. We will have to wait and see how June quarter fares for the company, and probably then only there could be some concrete statement on whether occupancy levels have definitely dropped at the current levels. Apart from that, if you look at some of the analysts who have coverage on the stock, they have been cutting their earnings estimates for not only FY23 but FY24 as well. And that goes to show that the confidence on the earnings side has been hit, even though it may not have been totally evaporated, but it has been considerably hit, and therefore the current stock price definitely reflects those concerns, and the upside for me probably will be limited.
The stock has managed to come back into the Nifty. That means that a lot of passive funds will be investing in the stock. So that
but
is
also a lot of people who have been betting on those passive funds to come in will be selling out. So Santo, I don't think the stock is going to go anywhere for the near term.
So what is the nugget of wisdom that you have for us today?
Well, Santo, we know that internet companies exist over the internet, right? But recently,
where else would they invest?
Exactly, right? But recently, have you been hearing about some of those companies opening up stores on the ground? I'm sure you would have heard about Amazon, doing an experiment in the US of opening its own retail department store. In India also, companies like Nykaa and Policy Bazaar and Lenskart have been experimenting with opening physical stores. I mean, Nykaa itself in the March quarter guided for considerable investment in opening their own branded stores in not only the luxury but mid-premium and then premium segments as well. Now, according to BofA, this does not suggest that internet companies are shedding their internet skin and getting into physical retail, but for them it represents a new way to actually bring more users for their internet business. Now, I know it sounds very counterintuitive, but for them, they believe that a lot of these companies are trying to open retail stores in second tier, third tier or semi-urban areas of the country. Why? Because the second part of India, there's one part of India which is very digitally savvy, which shops online, which has no problems trusting e-commerce brands like Amazon or Nykaa, for example. But there is another part of India which does not trust internet, right? They have been scammed many times. They are concerned of losing their money. They want to, when they pay the money, they also want to receive the good at the same point of time. And that does not always happen with internet companies because it takes time for you to deliver the services and the goods. So they feel that these touch points could actually make these consumers aware of the services that these internet companies provide, and therefore could end up, expanding the overall addressable market for companies like Nykaa and Policy Bazaar. BofA believes that Nykaa and PB Fintech within the listed space will definitely be the biggest beneficiary of this new emerging trend in the internet companies or the omni-channel space.
Well, CJ, that does sound counterintuitive, because one of the factors which was led to lower prices was very clearly the fact that distribution and other costs had been brought down. Now, once you start investing in offline stores, that means your margins will be further under pressure, won't it be? Already not that they are making great amounts of money.
Yeah, exactly. I mean, your cost of acquiring a user could probably go up. But then the argument is that if you can expand the market and you can grow at a faster click,
and
then probably the revenue, not a very nice dig, Santo, but they believe that probably the growth or the revenue they will make per user will justify those higher costs in acquiring those users. And probably if they can do it at a particular scale, and at scale everything becomes affordable, if they can do it at a particular scale the way they have done it on the internet, maybe those costs could be justified or may look very minute in the longer term.
Well, that only goes on to show that the old ways of thinking don't really change. That old school has its place under the sun, no matter
what. At least for the timing. At least for the timing.
Well, so what do we have on the horizon? Earnings season
Santo,
is over
earnings season is over, definitely, but we have some economic data coming in, not only in India but abroad. The US manufacturing as well as job openings data will come out later in the evening, so that will be quite critical for the markets in the US and global markets. Apart from that, tomorrow OPEC members will be meeting for the second day of the meeting, which is the main body's meeting, and we know they are meeting in the shadow of EU's ban on Russian oil exports. So that will investors will probably wait to see what the outcome will be, whether they will retain their supply cut guidance that they have currently, or whether some members will probably look at boosting their export, given that oil prices are at a level that they are at this point of time.
Well, thank you, and with that, it's a wrap on this edition of Markets with Santo and CJ. Do share your feedback in the comment section below.
And do follow us on the social media links at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and the Moneycontrol app. We'll see you again live at 9 a.m. tomorrow morning.